All right, thank you, Sarah and Carl. Welcome to the Halftime Report. I am Frank Holland in for the Judge Scott Wapner. Front and center at this hour, is it a pause or is it a pullback? Stocks are trying to avoid a fifth straight day of declines as tech turbulence, it picks up. And investors, they're bracing for Fed Chair Powell's speech at Jackson Hole. The investment committee standing by to break the whole thing down. We have here downtown Josh Brown, Jenny Harrington, and Malcolm Etheridge. But first, quick check of the markets. We got to get to Malcolm's video first. Quick check of the markets right now. You can see a lot of red on this board, down about 0.5% for all three indices. As we just mentioned, the S&P on pace for a fifth straight day of losses. The NASDAQ down about 3% over the last week. And really, that's where we have to begin. Josh Brown right here to my left as you look for the latest data. We're going to hold off on your camera shot for just a second.
Searching
for all the answers as we speak. All right, so is it a pause? Is it a pullback? We're going into Jackson Hole tomorrow. A lot of talk about what Jay Powell's going to say, what Tony's going to take, and what that means for Fed rate cuts and investor sentiment. What is your take as we await for that Jackson Hole speech?
Look, obviously, if Jerome Powell decides to come out and be super dovish, which is not my expectation, that will certainly change the tone, and you'll see markets start to rip. I know there's like a camp out there that thinks that Powell wants to use this platform, ostensibly his final Jackson Hole address as Fed chair, to do some sort of like fiery, politicized tirade about the importance of the independence of the Fed. I just don't see it that way. I think the Fed is looking to cool the temperature down, the political temperature down, also the temperature of inflation. But I do think that you'll get enough dovishness that it could be supportive of the market. I just don't think for investors it's really all that important. We've gone this long without a rate cut. Rate cut would be nice. I think rates are too high given the rate of growth in the economy and the state of the labor force. I think most people agree. So if they do 25 basis points and then another 25, or they do 50 and they sort of signal that's all that's needed, I just think that's a sideshow. The bigger story is whether or not this AI trade has legs into year end, and if it's powerful enough to drag the rest of the market along with it. So far, since the April 9th low, that has been the story. Russell 2000 has actually outperformed the S&P 500, and the mid-caps are no slouch either. So it has been a market-wide recovery from the worst of the tariff lows. We need that to continue, in my opinion. And of course, the only way it can continue is if these AI stocks are powerful enough to at least hang at current levels. I don't know that I need them substantially higher. The best clue that we'll get as to whether or not that's going to be sustained into the fall is whatever happens in reaction to NVIDIA's number next week. I really think that's the next big thing on the calendar for the stock market after we get through the events of Jackson Hole.
You know, Josh, it's funny you say that. You sound like you said most people don't think that we need a rate cut to move the market higher. You're actually echoing some sentiments. I was talking to Steve Sosnick from Interactive Brokers a short time ago. He says, what are these rates restrictive to? They're not restrictive to the markets. They're not restrictive to speculation, not restricted to private credit. So really, he doesn't feel like a rate cut's needed to keep the rally going.
They're hurting the housing market. It's hurting the housing market.
But we saw new highs after what a lot of people thought was a better than expected CPI, because they thought that could lead into a rate cut, maybe 50 basis points. So why are so many people cheering for a cut if we don't need it?
All right, I'll explain why. Only like 20% of people have a meaningful amount of exposure to the stock market. So the real story of wealth in this country, it's all tied up in houses. For 55% of households, their house is their biggest financial asset. And the reality is the housing market needs rate cuts. I would argue the best thing for the middle class of America would be more activity in the housing market. I'm not saying higher prices, I'm saying more turnover. Existing home sales have been horrendous for years now, and that's what's being held back by Fed funds rate in the fives, in the high fours. We really need to see a situation where mortgage rates come down. We need to restart activity in the residential housing market. And until we do that, basically we're playing this game where the wealthy get wealthier because of their outsized exposure to the AI trade and to large cap stocks. Okay. And everyone else is sitting here like, I don't know, everyone's saying the economy's so great, it's not great for me. We need to bring liquidity into the housing market. We need to lower rates for that reason. And by the way, I don't think bringing rates down by 50 basis points is going to be some like calamitous thing for inflation. I really just don't think it works that way. So I think it's overdue. Just my opinion. I'm not on the committee, so who cares? But you asked me, what is it holding back? It's holding back, I don't know, 100 million American households that really would like to refinance.
Yeah, fair point. Main Street and Wall Street are not the same thing. Malcolm, I saw you kind of nodding your head. Do you agree with Josh's take that we don't need the rate cut for the market, at least? Maybe everyday Americans need it for more liquidity in the housing market where a lot of their wealth is.
Yeah, I think Josh was over there searching for his copy of my notes when he was getting started there. But to the point about housing, I think it's interesting that we just got commentary from Redfin that we're seeing home buyers walk away from house purchases at a record rate. And so if you think about where I live, D.C., where a teardown starts at $1 million, it feels like an eighth of a point is the difference between getting that home and not. And so, yes, certainly for anybody who's looking at purchasing a house, potentially refinancing a house, rates are restrictive. And so when you talk about the stock market versus real estate, yes, I agree. We don't necessarily need 2 cuts this year, 1 cut this year. Who cares unless it's something massive like 50 basis points each time or more. Not going to be additive to the AI story, because realistically, Microsoft isn't going to borrow to spend $80 billion to build out data centers. Neither is Amazon, neither is Alphabet, neither is Meta, whoever else. And so the cuts don't really have anything to do with that AI story that's been really carrying the markets for the last year and change.
All right, Jenny, I see you have your own notes in front of you. You're not searching for anybody's notes. You got your own thesis here. First, let's go back to what Josh was saying. Do you think the market needs a rate cut? And then if the market does need a rate cut, how do you explain some of the action we have today? We also got earnings from Walmart. They flagged tariffs. Yesterday was Estee Lauder. I mean, we continue to hear this tariff story from retail names.
Yeah. So I think actually Josh completely nailed it. I wouldn't argue for a remarkable change.
Mic drop.
I know, right? I wouldn't argue with
Jenny, don't do this. We don't need to
don't worry, I got more. Don't worry.
this.
No, I'm just telling you, like, it doesn't happen often, Frank. So when it's there, I just need to be like, holy smokes, Josh.
On a very special halftime report.
Oh, isn't that sweet? I should bring you flowers. But what I don't think we do need a rate cut. I think what's happening in the market right now is neither a pause nor a pullback. I think it's potentially just a consolidation and a reshuffling of leadership. So I like the way you said we need the top 10, the Mag 7, the AI play to at least not crack up, and I don't see any reason they should. They do have some stretched valuations on that mix, but they also have truly spectacular earnings. So like maybe they just need to consolidate, and within that consolidation, maybe then there's a leadership shift going on. So we see things month to date like healthcare and staples up 5%. IT down 0.5%. That makes sense to me. The healthcare and staples are trading at insane valuations. Like healthcare, Goldman put out a piece a couple weeks ago, and I'm going to misstate it a little bit, but it basically showed where valuations are, what decile valuations are relative to their 30-year average. Healthcare is in like the 0 decile of valuation compared to its 30-year average. It's just being treated as if there's no money ever to be made and no earnings. Money should flow in there.
Well, we're going to get to healthcare in a minute, but I think you're talking about the valuation of the broader market as well.
And about how there's leadership shift going on. So I think that's what's happening. And in that, it isn't a pullback, it isn't a pause, but there's going to be movement. So we're going to have some ugly days, we're going to have some great days. You're going to see things that have worked stop working on a relative basis, but I don't think anything crumbles. I think this administration has said to us very, very clearly over the last 4 months that they will do everything they can to keep asset prices high.
So by the way, is this one of the ugly days? I mean, we did get Walmart earnings, flagging tariffs is an issue. We saw higher than expected jobless claims, something that the market certainly reacts to on a week-to-week basis. By the way, Chris Larkin, head of trading over at Morgan Stanley, out with a note today saying that those higher than expected jobless claims, they may be less of a story for the market than renewed concerns about tariffs driving prices higher. And then he goes on to say, if the Fed appears to be favoring the inflation side of its mandate, well, the market could take a hit. And obviously tomorrow, we're going to get a lot of clarification from Jay Powell. So you'd agree with that? That right now, the Fed's probably focused more on inflation, or potentially more focused on inflation than the job market. And let's not forget, we had downward revisions of about 250,000 jobs for May and June as well, on top of this hotter than expected jobless claims reports.
Yeah, look, my personal opinion is that the risk is to the downside. The risk is not to higher inflation. Inflation is now deliberate and systemic. So Walmart is talking about as they restock items, they're doing so at higher prices. And of course, some of that has to be passed through to the consumer. Everyone understands how this works. And they're saying this is not a thing that's out in the future anymore. Now we're depleting inventory of things that we had purchased 6 months ago, and we're adding things at the new higher prices that are driven by tariffs. So yeah, it's a factor today. And I think when you combine that with how difficult it is for college graduates right now, for example, to get jobs, how difficult it is to quit a job, get another one, and get a wage hike. The wage growth is now basically gone at this point. So you have rising prices in the economy with slightly elevated CPI reports with no wage growth. So it's a recipe for consumer unhappiness, so to speak. So, but again, which consumer? So we've got this K-shaped situation where if you're a stock market American, meaning you've got 7 figures between your IRAs, your 401ks, your brokerage account, and maybe you work for a company that compensates you in part with stock options, this is the greatest economy in the world. Every month, your net worth goes higher, and you're spending with abandon. If you're not a stock market American, meaning you're younger in your journey, you haven't accumulated $1 million in a 401k, you don't have stock options from some technology company that hired you 5 years ago, you're not in the same reality. And those are the people that we have to pay attention to. So when Walmart reports, pay attention. They beat on revenue but missed on earnings per share. The last time Walmart missed on earnings per share was May of 2022. It's fairly rare. Wasn't a bad report. They had a lot of good metrics within the report. But my God, we're going to ignore Target and we're going to ignore Walmart because they're not mega caps, because they're not in the AI trade. It's crazy. Pay attention. And when you do that, you realize the true risk is to the downside. And that's why I think the Fed should be cutting, not worrying so much about inflation, which, quite frankly, they can't even control anyway.
All right, so right here, we're going to go to this banner right here. Is there more market choppiness ahead? Jenny, what's your take? A lot of notes out today, kind of some conflicting views. I want to read 2 of them to you. First, from B of A. The headline here, slippery September for equities. They say September is the weakest month for the S&P. It certainly has been over the last 10 years. S&P pulls back about 2%. According to their data, the S&P declined about 56% of the time on average, and they see the latter half of the month being riskier. Now, that's B of A. And we have our friend Tom Lee from Fundstrat. He says, for those concerned about a trend failure, the one level to continue to watch carefully lines up with early August lows at approximately 62.12. And until or unless, he says, this level's broken, dips should find support and begin to work their way higher into mid-September. So literally, Tom Lee taking the opposite position. Right. Are you seeing some market wisdom in either one of these takes?
I mean, they both could be right. I think here's the challenge to responding to those. I had lunch with a client yesterday. And he's a nervous guy, right? Most of my clients are kind of nervous or they wouldn't be in a dividend income strategy. And he said, he gave the whole kind of macro outlook, more like the B of A outlook. And he said, it could get ugly out there. And I said to him, define it. Is it the economy? Is it the S&P 500? Is it the bond market? Is it the consumer? And then to Josh's point, which consumer is it? The high-end consumer, or the average consumer? And this is what's making it really challenging. So even in both of those comments, I look at a portfolio like what I manage, where it trades at about 13 times earnings, has a 5+ dividend yield. I don't think it is going to get too ugly for stocks that have been pretty ho-hum year to date. I think it could get ugly for maybe the NASDAQ that still trades at a really premium valuation. It could get ugly for the top 10 or 7 stocks in the S&P 500 that are still far richer and have outperformed the other 493. So it's just hard to answer these questions right now because there's enormous bifurcation, and the outperformance that influences a comment like, the market's up 9.5% and trading at 23 times is really concentrated in a tiny handful. So it's making this prediction and looking forward super hard right now. Even in the economy, like which parts of the economy could it be referring to?
I think it's dangerous too to keep worrying so much about the boogeyman lurking in the closet when we consider the fact that it's one narrative that's really driving the stock market right now. It's AI or nothing else. And if you look back to 2023, we were supposed to have a recession in 2023. The stock market wasn't supposed to do well. all of a sudden ChatGPT shows up, Microsoft does like 50% or something for the year, and everyone's like, oh my God, this is the best bull market of all time, start taking shape here. 2024, we were supposed to get our recession. Stock market wasn't supposed to do well. NVIDIA did 1,000,000% in 1 year, and all of a sudden, here we go. The AI trade is still going. And if we're really in early innings, like anybody who continues to focus on AI will tell you, then that should be what we're focused on, not so much the day-to-day choppiness around things like, are we supposed to be worried about the earnings coming from Walmart telling us what we already knew about tariffs being restrictive?
Right. Well, really quick, are we sure we're in early innings? We heard Sam Altman come out and say this whole thing might be a bubble. MIT came out with a study saying 95% of S&P companies don't really see a benefit when it comes to generative AI. Go ahead, Jenny.
So it's interesting dissecting the Sam Altman comment, right? What's the bubble he's talking about? Are the AI businesses a bubble? No.
He is the bubble.
Right.
He's going to raise money in the private market at $500 billion.
Right, but that's
He's
the point.
The bubble.
So here's the thing, like AI in and of itself is in extremely early innings. It might be in the first pitch of the first inning in terms of how it changes the world.
I more meant the
in terms of
trades, 'cause these
valuations,
stocks have run up incredibly.
the stocks are insane, but you need to bifurcate those two out too. So there's the business and then there's the valuation. And I think the valuations are bubbled.
Can I agree with Jenny now?
Please. What is happening today? Do you want to go out for lunch afterwards?
I do.
Okay, we're both busy, I know.
So
I think we're all going, but you guys are paying.
So it's definitely a bubble. AI CapEx. Every CapEx boom is a bubble. They don't all end up with an 85% crash, though. Not every bubble unwinds that way. And we don't know if it's 1997. Just because you say something's a bubble, you could have 3 years left. It could get so much more extreme. So it's fine. It's a bubble. Everyone's going absolutely crazy with CapEx spend. Look at the stock market. Look at the leadership of the stock market on the year. It's utilities. That's an AI trade. Those stocks don't do that outside of AI grid investment, et cetera. It's financials. They have the return of the IPO, the return of M&A. Most of this stuff is being fueled by AI. And then technology, communication services. That whole thing is AI. That's the only story there is in the market. If you take that piece out, there's no way we run up 30% from the April 9th low. No, not a chance.
I agree.
All the stocks that have driven that performance are AI related. And even areas of the market like utilities, a normal person would look at that and say, wait, utilities are the leading sector? That must be a really defensive.
Just really quick, you mean industrials, right?
No, utility stocks have been on fire all year.
Yeah, but industrials are the leading sector.
Utilities are up 15.5% year to date. Industrials are also up 15.5%.
Yeah,
Tech is up 13, financials are up 10.
But what is driving that? It's all one story. It's this once-in-a-lifetime boom in infrastructure for CapEx. It's literally building millions and millions of square feet, transmission mechanism for natural gas, electrification. It's all one story. If you pull it out, you're talking about a 2% GDP growth environment with no more rising wages for people and declining employment figures. So you need this trend to hold up. I don't know how else to phrase it.
Well, speaking of the trend, though, really quick, we can put this up. The S&P equal weight in the S&P month to date. If you look month to date, the equal weight is outperforming the S&P market cap weighted by quite a bit. So, Malcolm, you were saying right now the AI trade's leading things, but actually right now it isn't. It's really the broadening of the market.
Like the last 2 weeks?
Well, yeah, for 2 weeks is a long period of time.
You're making my point for me, though. I'm worried about the boogeyman of the last 2 weeks, or am I worried about the entire year where all of the names that occupy the information services
But why are we
sector
totally discounting the last 2 weeks? We're showing the chart right here. The equal weight's up about 1 1/4. The market cap weight
because
is up
the
just
argument
over
is
0.5%.
where are we in the first or second inning of the AI trade? The last 2 weeks is a blip on that radar.
Right.
So I'm really focused on where are we over the 10-year span as investors, not so much focused on have we lost confidence for 2 weeks. That's really just profit taking from folks that have done really well this year, or at least since April 9th, and they have to figure out a place to put that capital, and they haven't figured that out yet.
But is it possibly investors getting, quote unquote, religion when it comes to valuation?
No.
Josh, I know you're not a valuation guy. But again, I was talking to Steve Sosnick from Interactive Brokers. He says he doesn't think investors are getting religion.
They don't care.
They're thinking about stopping into the temple, the church,
They don't care.
and just talking to somebody.
No, everyone.
It's a bull market. This is with religion.
No.
They're waiting on the next opportunity. Where is the place to deploy this capital? I just raised cash by selling all my winners that I won really well since April 9th. what do I do with this cash? I haven't been given a compelling enough reason yet in the form of a pullback of 5% or more, and so I'm just going to sit on it until I have my opportunity.
Do you think the person that buys, the Circle IPO 100% off its offering price on the first day is focusing on valuation? No, they think some other idiot is going to come along and pay another 100% higher the next day.
I think
the investors that you are referencing, Interactive Broke, respectfully, valuation is not the game.
That doesn't sound good.
No.
Start with respect.
Respectfully, the leading factor this year is momentum.
Ironically, I think we were all sitting here together the day of the Figma IPO, right? Do we think we've lost any momentum, any confidence in this market since we had 1,000 people running around the floor here cheering, excited about?
That was an incredible day. Outside was even better. I think everybody here obviously walked outside to leave the building. It was incredible out there. What's changed is we have Jay Powell tomorrow, and then about 5 days from now we have NVIDIA earnings, which 2 inflection points in the market maybe in 5 trading days.
You know what, let me say something. So I had a conversation this week too with a new client who actually called in from seeing me on TV. And it's interesting because this guy has managed his own portfolio his whole life, and it's all in the high flyers. It's all Microsoft, Amazon, NVIDIA, blah, 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 blah. He's late 70s, and he's like, you know what? I just feel like I've made too much money. I've gotten too lucky for too long. And he's legitimately changing the whole portfolio over to a dividend strategy. I've heard a lot of that lately, whether it's an older guy like this one or my friend's son who's a younger guy who works at one of the, I don't want to say it, but like one of the super high-tech companies that we mention all the time, who's just saying, I'm too nervous. This stock shouldn't be up 400%. These numbers are just too high. And it's just that simple. People feel like they've gotten
the market is correcting this in real time, though. Pull up a chart of Palantir, guys. Give me like 6 months. So they put up an earnings report that was one of the craziest, best earnings report I've ever seen a company come out with. Like every metric was explosively higher.
But
Look how fast. Look how fast they took away that post-earnings pop. It's gone in 3 days.
Right.
Figma is down huge from that opening day pop. So is CoreWeave. So is Circle. Bullish. Like a lot of these IPOs, we talk about them the day they happen, to your point, and then a week goes by and they give up so much and we just stop talking about them.
There's $16 billion sitting in SPAC companies waiting to be deployed right now.
Right.
Fine,
the wave is not done.
$16 billion is like the tip of my finger. You know, it's nothing. It's a lot. It's a big number, but it's also nothing in the context of the overall market and what influences it. But let me put the button. So Palantir, releases those earnings. They're extraordinary.
Yeah.
And it's still trading at 155 times earnings. And people are at 400% in the last year. And they're like, you know what? This simply makes me nervous to have what was 5% of my portfolio now 20%. And people are getting nervous. Like, our meta position in our clients' portfolios is huge again. It just keeps getting huge, and at some point, you just say, hey, let's take 0.5% off. Let's take a little off. And I think that psychologically is going on very broadly.
We got to move on, but I'm not sure you're not proving my point, Josh. I mean, I'm looking at, by the way, Palantir trades at 210 times forward earnings. And as you mentioned, good earnings report, nothing really changed, and all of a sudden this stock's declining, it's down in correction.
It doubled into the earnings report, is my point. And then it had, you know what happened on earnings day? The last remaining growth fund managers that don't own it is like, oh my God.
Yeah, you know what?
I have to buy this. And those are the buyers.
And you know what? If your manager did that, you should fire them.
But who do you think is the buyer?
Speaking of buyers, we got to move on a bit. Malcolm, you're making some moves in the financial space. What moves are you making and why?
Yeah, so I just initiated positions in Carlyle and also Blackstone. This is a trade specifically made following the executive order that came out. So this is a buy the tweet, sell the news kind of a scenario where distribution has really been the problem in the PE space, the private space altogether. I've been getting out of private positions for the last year on behalf of clients. The space has just become so crowded that it makes me nervous to the point that you guys are talking about with the public markets. But I was actually looking for an opportunity to still capitalize on that trade. And so Carlyle and Blackstone are two companies that are most likely to benefit from retirement plans starting to incorporate these types of funds into their retirement plan offerings, into their target date funds and everything else. And so as JB so succinctly put it the other day, why be an LP when you can be a GP? I think that makes a ton of sense. And so this is an opportunity to capitalize on that next wave, that transition that's coming from the private markets.
I'm not going to say we have it on camera. We
almost had a furniture malfunction.
I gave him props in it, and he almost fell out of his seat.
I almost fell.
Also, JB, I never even heard of that.
I'm in Carlisle Group too, and Malcolm, I couldn't agree with you more. We ran a study a couple of weeks ago from my website where we looked at a market cap weighted basket of the 10 largest private equity, private credit firms. So Carlisle, Blackstone, KKR, Ares, Apollo, they're all in there. And it turns out $100 invested in those stocks over the last 3 years on a market cap weighted basis turned into like $260, whereas $100 invested in the Bloomberg PE index only turned into $112. So basically, the stocks of the companies selling the funds have drastically outperformed the products that they sell. I don't know what will happen in the next 3 years. Maybe that's unfair. It's not that big of a window. But generally speaking, I agree with what Malcolm's saying. I want to be invested in these companies because we've just unlocked a whole new category of investor for their funds, and I think it's going to work.
All right. Near term, though, I want to go back to what Malcolm was saying, that he's actually helping some of his clients unwind their private market positions. Isn't that some of the reason for some of the weakness in some of these names? Carlisle is actually the outlier, but some of the other names we talk about in the alternative investment space have been weaker because a lot of investors, according to the Journal at least, are worried that they're going to have to sell their older positions at a less than ideal price. So what you're doing, it seems like they're doing at the same time, trying to unload some of those positions. Are you worried that's going to be weakness for these stocks longer than just the short term?
I think the focus has been too heavily placed on the transaction fees that these companies earn anytime, the success fees is the term I'm looking for, that these companies have anytime they exit these positions, instead of, and that makes them cyclical. And you should really be focusing on the assets under management fee that these companies get to collect just for managing these funds. So about 75% or something for Carlisle specifically of their revenues that are coming and getting returned to their shareholders are in the form of assets under management fees. So the success fees don't matter nearly as much. Yes, it's great when they have those liquidity events that lead to that. I don't know what the uncaptured deal flow dollars are that are sitting in those opportunities that are looking to be liquidated, but the moment they have those liquidity events, yes, that'll be great. That's additive to the story.
Okay.
But really, it's the AUM fees that these companies collect just for managing those funds.
We got to move on. All right, coming up next on Halftime, a new chapter in the streaming wars. Disney debuting a flagship ESPN app just in time for football season. We're going to get the committee's take, and then later, Josh Brown has his best stocks in the market. He's focusing on one big industrial name he recently added to the list. Halftime's back in just 2 minutes.
A number of other companies are exiting their linear business completely, meaning they're selling off the channels that serve the linear television ecosystem. We're doing the opposite, actually. We're combining them, which gives us the ability to aggregate both subscription fees and advertising on both sides and essentially end up with a business that's actually larger and more impactful than it would be if we were to separate them completely.
So that was Disney CEO Bob Iger speaking exclusively to CNBC's David Faber. Disney betting big on combining its linear and streaming assets as the company launched ESPN's new flagship streaming app this morning. Jenny, coming over to you. You own Disney.
We do. So I think when we hear things like this, it sounds really exciting. It sounds cool. People are like, oh, should I look at Disney? And it's a good time to consider the difference between a good story and a valuation-based investment thesis. So first of all, this isn't new news, right? It launched today, but as the investors have all known about it for a long time. There's a reason Disney's flat today, because it actually doesn't change the investment thesis. What we're hearing today doesn't change the investment thesis whatsoever. If we look at just the numbers, I don't know that if this is actually accretive or good for earnings. I think it's just kind of already expected and in there. And then when we look at the valuation of the company, here's what we've got. We've got a stock that's trading at 18 times earnings and has EPS growth in the next few years expected to be 18%, 10%, 11%. That's a pretty nice matchup of earnings growth and valuation for a company that's nicely diversified. You know, they've got the theme parks, they've got cable, they've got movies. Everything's doing pretty well. So we love this, but this ESPN thing has zero impact on our investment thesis.
Did you watch the interview? There was one part when Faber asked them both about their ability to get pricing power going forward. And I mean, it didn't sound like they had a lot of conviction about the ability to upsell, especially today on a day where Apple's increasing the price of its Apple Plus subscription service. What did you make of that? And by the way, the stock's down about 0.75%, which I do think is a bit surprising.
Yeah, not really. I mean, the market's down 0.5%, so it's more just kind of in line with the market. But that, you know, Disney's not great at issuing and they're not bad at it. They just actively and intentionally don't do it. They're not big on issuing guidance. So of course they're kind of hedge on that. And I don't see why it would be accretive to earnings. So like right now, cable companies are paying about $10 for ESPN. Theoretically, this would be $30. So theoretically that would be higher. But what we think it really might do is just highlight the value of having a cable subscription at $70. So people say, well, I can get just ESPN for $30, or if I buy the cable subscription, I get like the whole package. Now, you all know I'm like the least sports lover out there. I don't follow sports at all, but my partner Greg does. And as Greg says, if you're a real sports person, if you really love sports, you're not going to get just ESPN. So that, you're going to get a whole package.
I think the salient thing is if you're watching multiple leagues and you need to watch every game, it doesn't matter. You're going to pay for it. And if you're under 40, it's not even cord cutting anymore. It's very highly likely that you never even had a cord to cut. So it's interesting. There aren't going to be any NFL games left on broadcast. They're all going to be on different streaming apps. That's just the new environment we're going into. This seems like a very high-priced entry into the market for non-sports fanatics, just people who want to casually check out, some games each week. I'm not sure what the uptake rate will be, but I do think it'll benefit the idea of bundling. So I do think that maybe they start high for the standalone app and then introduce these bundles and new ones in the future that are at lower price points, play around a little bit with how much of this is ad supported. Obviously everything sports is ad supported, but just by its nature. So it's going to be a while before we know what this really means to Disney's economics. But I would argue at least they're trying something.
I agree with that. At least they're not resting on laurels and they're trying to be forward thinking.
And we're back on halftime. We're back with Josh Brown's best stocks in the market. Josh, you have a new name that you're adding to the list.
Yes. Jenny, Dividend Duchess. You know what dividend aristocrats are, right?
I do, Joshy.
Am I distracting you from something?
No, I was actually checking out what the yield on Illinois tool. Oh, sorry. I jumped the gun.
I can't work with her. All right. Dividend aristocrats are stocks in the S&P 500 that are raising their dividend every year
for 25
years or more. Okay. Do you know what a dividend king is?
Yes.
50 years or more. Okay. There's only 69 dividend aristocrats in the S&P. There are only 55 companies in the S&P that have raised their dividend every year for more than 50 years. And Illinois Toolworks is one such company. Most of them are, believe it or not, Midwestern industrials, which I don't know what the reason is. But ITW is the ticker. This name popped up on the best stocks in the market list. And I think it's part of this kind of like overall rally in industrials that we talked about before in the A block. And I think it might be a little bit premature. It hasn't quite broken out yet, but we wanted to highlight it because you've got a moving average crossover this week, Golden Cross, 50-day getting above the 200-day. Clearly, the buyers are in control of the stock. And if it should break out, I think you would probably be looking for that to happen somewhere around 270, 275. There really are no sellers overhead. You had a little bit of a rally last November. Maybe you have to wrestle with that level, but I think it'll break out. And if you're an investor, you can kind of prematurely bet on that breakout. In the meanwhile, you're getting 2.6% dividend yield. And if you intend to stay in stocks for a very long time, again, Dividend King continues to raise that yield. So we like the stock right here. For traders, maybe give it a bit, let it actually break out. But I think it should be on people's radars.
Yeah, and I think it's an interesting time where we can highlight the difference between a dividend growth company and a dividend income company. So S&P 500 overall has a dividend yield of about 1.4%.
Yeah.
This is 2.6%. So it's not really that high. If you really need income, this isn't where you find it. I always say, look at the dividend aristocrats as a quality screen, because what you have there are really, really, really high quality companies. When a company's paid for 25 years, much less 50, you know that they have incredible control over their business, over their cash flows, over the future of the company.
Position.
Great,
right.
Yeah, great.
Agree.
But don't expect to go into it and just start minting cash from dividend income.
All right. What's your general take on industrials? I know you have a lot of industrial exposure, Jenny. I mean, I'm just looking at the list. Northrop Grumman, General Dynamics, UPS, United Rentals, et cetera.
Well, you can tell from the list that you just read off that there's no consistency. So I'm not saying I want to buy industrials overall. I'm saying within the industrial segment, there are compelling companies. So there's really nothing similar between Northrop Grumman, Carrier, and and like
Illinois
General
Toolworks.
Dynamics. Yeah, and Illinois Toolworks. They're different. It just is, it goes back to our earlier part of the conversation where we're talking about AI stocks sucking all the investor dollars up and all the focus up. So you have lots of other companies that have been relatively ignored. And in that sector, you can find compelling valuations coupled with decent earnings growth. If you don't mind, taking a pause on the high-flying growth stocks, you can get into these with a decent little yield and a nice valuation. So, yeah, so I don't have like a broad theme on them. I just think that there's opportunity in the sector.
All right, Josh's best stock in the market, Illinois Toolworks, ticker ITW. All right, coming up, shift gears just a bit. You own Regeneron, obviously, a biotech company. What does this story make you think about that company and its ability to produce in the U.S.?
Yeah, so kind of like Disney, there's no impact whatsoever on our investment thesis because of this. It's nice, maybe it ends up being beneficial, but it doesn't impact the numbers. So when you look at Regeneron as a standalone company, you see a stock that's down 50% over the last year, 15% year to date. Why? Because they had like some really bad news on one of the drugs in their pipeline. But the rest of their pipeline is enormous. Trades at 14 times earnings, has a 7% free cash flow yield. This isn't one of our dividend payers. This is actually in our disciplined growth strategy. And the earnings growth ahead should be 6% next year and 14% the year after that. So maybe producing more in the U.S. ends up being good, but at this point it doesn't impact the investment thesis. Standalone, the investment thesis argues for a company that's well valued with decent growth ahead.
All right, shifting gears once again, just broadly about healthcare, Malcolm. How are you viewing that sector right now? We have seen a rebound in recent days. I know you guys said 2 weeks isn't that long. Rebound's been about 10, 12 days.
Yeah, I think healthcare is still, for me personally, a tough sector to make money in. We talked about all the sectors that are really leading right now. There's not a lot happening right now as far as AI is concerned that's going to impact that narrative. Obviously, that is a sector that is ripe to be disrupted by AI. I would love for a lot more tech to be invested in that space, but I think that's probably a second or third wave coming for that AI trend. Talking healthcare specifically, but today it's just a tough place for me to invest, given all the other places I could allocate capital, financials, technology, et cetera.
Healthcare sector up about 0.25% right now in a day where the major indexes are lower. Coming up next, and we're back on the halftime report with final trades. Malcolm Etheridge.
I'm going to go ServiceNow. It's down about 17% for the year, also about 25% off its 52-week high. But I think it's become a victim of its own success, so it's probably creating an attractive entry point.
Jenny Harrington.
Okay, Bristol Myers, 5.5% dividend yield. It has paid a dividend for 55 years straight. Not an aristocrat because it hasn't raised it all those years. Still a great stock.
Josh Brown.
Happy all-time high today to Live Nation. Also, shout out to Troy, Rashad, and Ian Dunlop at Earn Your Leisure for InvestFest this weekend. Major investor event. We wish you the best.
Sending shout-outs. That's how we're ending the show.
That's how I do now.
All right, that's going to do it for halftime.
Hey, I'm George. This is Blue Cloud Trading. It is Thursday, August 21st, 5:05 p.m. As I'm recording this video, we're going to do some analysis of the indices here, the Dow, the NASDAQ, the S&P, the Russell 2000, end of day. We're also going to take a look at a few other things, folks. We're going to take a look at the ETFs that represent those indices. Okay, we're going to take a look at the CNBC stocks that were talked about on the halftime report today. There's about 13 that I'm going to be covering. Not all of them, but I'm going to be covering the following stocks here. And then we're going to take a look at some of the Mag 7 stocks like Tesla, Apple, Meta, as well as some of the strongest sectors. And why don't we go ahead and get started? Okay, so here we are. Like I said, the market actually today was not that great. It was slightly down, 0.34% for the Dow, 0.34% for the NASDAQ, which is interesting that they both dropped about the same. S&P 500 down 0.40%. And the only index that was up was the Russell 2000, 0.25%. Let's take a look at the heat map, and we'll get a better sense about the individual stocks and how they performed today. Well, you can see basically pretty much everything, the majority of the stocks were in the red. Walmart and Costco took some big hits today. Target as well. Walmart specifically 4.49%. Meta was down 1.15%. Tesla was down 1.17%. What stocks did well today? Energy stocks. Some of the healthcare stocks like Pfizer, Merck, Eli Lilly, Johnson & Johnson were up. Utilities didn't do so well. Real estate didn't do so great. Let's take a look at the after hours performance because there were a couple of stocks that were down. Let's take a look at those. Intuit down 6.2%. Okay, Workday down 5.09%. This is after hours now. So that's interesting too. And how about the groups, the sectors? Which sectors were up the most today? Well, you can see energy up 0.72 and basic materials 0.66. Consumer defensives took a big hit, down 1.25%. That's the Walmart, of course. Utilities down 0.59. Consumer cyclical down 0.45. But for the 1 week performance, healthcare has been the leader. Real estate, consumer defensive, and energy have been the positive sectors. And then you can see technology down 3.38% this week. 1 month performance so far, communication services is up the most, consumer defensives, healthcare, utilities. Industrials, real estate, consumer cyclical, though, in the negative. All right, let's take a look now. We're going to use the Ichimoku indicator. Okay, we can superimpose this indicator. As you can see here, we can superimpose it on the charts and get a better sense about what's happening technically for all the things I just mentioned that we're gonna cover. So let's start off with the Dow Jones, and you can see how price has been stuck. So we've been basically hitting our head at the 451.34 level multiple times. You can see back here. Okay, now those dates go back to November 29th of 2024. Okay, December 6th, 2024, and then you can see how price dropped. Then we came right back up to that same level, okay, on January 31st, February 7th, February 14th, okay, stalling at that 451.34 and then dropping. Now, what's going on? We've been hitting that level. I mean, we came up to it pretty close here. It started on July 3rd. And since July 3rd, we've basically stayed in this, consolidation stage here. So it's just been stuck, okay? Pretty much all the markets have just been moving sideways. A lot of my stocks too have just been going sideways. Here's a daily chart, not all of them, but some of them. And you can see the index here has been on the, just kind of stuck. If we look at the weekly chart, that's the weekly. This is the daily chart. Same situation, right? And the positive thing that I would mention about this is the fact that price is still holding up above the moving averages, the 9 period, that green line, the 26 period, the red line. That's called the Tenkan-sen. That's called the Kijun-sen. That's the part of the Ichimoku cloud. Then you've got the single span A above the single span B. That's the part of the cloud there. That's positive. And we've got the Chiku span. See that white line there? I don't know if you can see it. Let me zoom in a little bit so you can see it better. That's above. I'm going to get rid of that line. See how it's above price? That's also bullish. So we've got all the elements of Ichimoku telling us that this is we're still in a strong uptrend overall. It's just that price has been kind of stalling, right? And here's the weekly chart. And again, same situation, right? We've above the moving averages, above everything. The question is, here's what's going to happen tomorrow. Here's the big deal, right? Powell, he's coming out tomorrow to deliver, it says here, what almost certainly will be his last keynote address at the central bank's annual conclave during one of the most tumultuous times in its history. Amid several controversies, Powell could use the speech to at least take a sideswipe at the political distractions, even if he holds to past practice of not taking direct aim. You probably noticed him becoming more and more frustrated with Donald Trump, especially when they met up in person recently. And the speech is billed as an economic outlook and framework review, indicating Powell will take time to provide his views on broad conditions as well as discuss the Fed's long-term policy goals. So that's going to be interesting. And so tomorrow's going to be a big day. I think that's going to be the trigger and lead to either, if he's dovish, okay, you're going to see the price breaking through that 451.34. Because remember, if we look again at that daily time frame, you see all these red candles here, right? We've been just slowly, every day it's just been dropping slightly. These haven't been major drops, okay? Nothing major has happened here this week. It's just been negative as far as stalling at this level until we get that information tomorrow. But if price breaks through that 451.34 level, expect the Dow to move up, the DIA ETF. Here's the Russell 2000. Okay, this one has pulled back as well. Today was up 0.25%, getting above that Tenkan-sen, the 9 period, above the 226. It's not above the 226.72 level though, based on these prior highs. So we'll see if this can also turn bullish tomorrow. FEZ. Okay, this one is the Eurostox 50 ETF. Now these three ETFs have a blue flag, and that's because they are bullish on both the weekly and daily time frames as far as the Ichimoku is concerned. So you can see it's pulling back here after hitting that 61.24 level based on that high right there, going back to Wednesday, July 29th. Okay, that was the closing price, 61.24, and that was also the high of that particular day there. And so if we can get above that, it's going to be very bullish for the European stocks as well. The S&P 500, the SPY, dropped 0.40%. It lost its blue flag today. Actually, yesterday. I didn't do a video yesterday. You can see it dropped under Tenkan-sen. But here's the thing. It is still stalling, and it is holding up above that 26 period. That's really critical and important, I think. What about the QQQ ETF? This one has dropped under both the Tenkan-sen and the Kijun-sen. So under the 9, under the 26. But just keep in mind that, yeah, it was down 0.46%. But if you look at the weekly chart, we're still holding up, right? So the longer time frame, the weekly, is still very bullish, okay? And we've experienced new highs here with the QQQ breaking that 540.81 level. So, yeah, let's see what happens. The VIX was up a little bit, 5.8%. These aren't big jumps in the VIX. The volatility has not increased that much. Tomorrow I'm very curious. You know, I might have to hedge my account if I see things going sour. But basically right now we're still at a level of 16.6, as you can see here, which is a really neutral type number for the VIX. It's not really conducive to a big drop or a big spike. It's just kind of moving sideways right now. All right, let's get into the if we see basically the VIX pop, okay, and it gets about, I don't know, around over 20 or so, that's going to be an indicator. The 200-day moving average is at around the 19.3 or so, something like that. So if it gets above 20, I think it's going to be serious. You'll see that the market will start dropping. That's the VIX, market volatility index. So it's the inverse reaction to the market. CNBC stocks. These are the stocks that they talked about. Okay, RSP, Invesco, S&P 500 equal weight ETF, still holding up above the moving averages. Looks good on the daily and the weekly. Down 0.35%. LYV, that was Josh Brown's final trade. Okay, let's look at the daily chart here. All right, let's pop that up there. And I actually had a position in this back. I added it on July 14th. I closed out of it on August 13th for a 7% profit. It has moved up slightly, not that much, only about maybe around a little under 2% or so since I closed my position. And so this one still looks pretty bullish, but it has in fact been just kind of stalling, right? You can see that right there. What about Walmart? Walmart dropped 4.49%. This is where it closed at 97.96. But as I mentioned, let's see what it looks like after hours. I'm just kind of curious. Post market, yeah, it's down a little bit more. It dropped a little bit more, so that's not good for Walmart. All right, let's go back to regular hours. There we go. Target. Okay, you can see here down 1.65%. It's under the Ichimoku cloud. That's very bearish territory. On the daily, let's look at the weekly chart. Okay. This stock has been under the moving averages here and under the cloud since we're talking about November of 2021. Okay, now there was a brief moment here on the weekly chart that it popped above the cloud temporarily, but all of the elements of the Ichimoku were not in play at that time, because you can see at that time basically the Tenkan-sen was under the Kijun-sen, the 9 period was under the 26, so that would not have been a good time to enter. So if you got out hypothetically here on December 10th of 2021, you could have saved yourself the drop that occurred. It came down about 55%. Now it did pop right back above the cloud over here, but as you can see, it stalled, and it probably wouldn't have been a good idea to be adding positions here because it was stalling at the 200-day moving average, right? We knew that the 200 was lurking right there, and so it dropped some more. It dropped, and now it is since that date right here from, like I said, from 2021 December, it's down 60.13%. So target's not something I would consider. In fact, it's looking even more bearish. Take a look at this. See that trend line right there? It was just broken today on the weekly. That's a weekly level. This candle could turn around if we get bullishness tomorrow, and it could come right back above. It is a dynamic candle, that one right there. All right, let's see. PLTR, but I certainly wouldn't be adding a position on that one. Okay, let's keep going. Let's take a look at PLTR. I've got a lot of notes here. Let's look at the daily chart. As you can see here, yeah, I had a position in this as well, which I closed out of on August 5th. It also moved up slightly more and then dropped. And now it's finding some support at that 148.21 level. I created that one back on July 16th, 2025. So you can see that's based on these prior highs over here. It found support, created a hammer. It could potentially move up tomorrow if things go bullish. It would need to get above the Tenkan-sen Kijun-sen on the weekly chart. It would have to also get above that Tenkan-sen right there too. All right. MTUM is the momentum factor ETF. That's an ETF that has been dropping, as you can see here, since this high up here of 249.15 or somewhere was that. The high was 248.90. Sorry, 248.90, which was an all-time high. It's actually dropped about 3%, so not much, but it's not looking particularly great at this moment. CG, the Carlyle Group, Josh Brown's final trade back on July 24th. And I think this was one of Malcolm's new positions. He was on the show too today. The Carlyle Group, CG. On the daily chart, it doesn't look terrible. It looks like it might pop back above the Tenkan-sen. Let's look at the weekly chart though. Okay, that's also looking pretty bullish. We've got, let me get rid of the lines for a moment so we can look at the indicator. Senko Span A is above the Senko Span B. Okay, check. Tenkan-sen is above Kijun-sen. Check 2. Price, okay, is above the 200-day. That's good. And the Chikou Span is above price. So all of these things are telling us that, yeah, this is looking pretty good. It also broke through this high, okay, and found support right there, came down to it after it dropped, found support, and now is kind of moving up. So I like CG, but I would hold off until it gets above the Tenkan-sen. BX, Blackstone Inc., is another one that I think Malcolm mentioned. Now, this one here has been dropping on the daily chart. You can see we've got essentially a lower high here from the prior one, and we broke this low. So that's not conducive to something that I would consider adding a position to. If you can see, if you look over here, the ADX is moving up, the ADX 9. I've got it at a setting of 9. That's the momentum, the white line. And when the red line is above the green line, that's very bearish, okay? And so it's beginning a downtrend here. If you look into the past a little bit, and we can see where the green line, for example, crossed above the red line. All right, and you know, we could see if we go straight up, it also broke through the Ichimoku cloud. That led to that nice move up. If we measure that move, it was approximately a 25.5% move in 1 month, in 22 bars. And then it's been dropping. So I would not add BX here. This is not a good time to add. Disney, inside the Ichimoku cloud, one of the rules of Ichimoku is you shouldn't add positions here when price is inside. A couple of other negative things, the Chikou span is under price and the 9 period is under the 26. Okay, and the cloud is bearish too. ITW, Illinois Toolworks. This one, okay, was, oh yeah, let me throw that notes back here. This was one of Josh Brown's best stocks in the market list. That was the one that he talked about today. So on the daily chart, everything looks bullish except for one thing, and that's the price, where it is in relation to the 9 period. It's under it today. It was above it yesterday and the day before. I think that tomorrow will be an a good indicator of whether or not we should be adding here. You can see that it's building a little symmetrical triangle type pattern right there. So if it breaks through that, it should be bullish and continue its move up. Because if you look at the weekly chart on this one, it's also above the cloud. Okay, we've got Tenkan-sen above Kijun-sen. We've got a future bullish cloud here with Senko Span A above Senko Span B, and Price is above the 200. So the Chiku span is still, it's not above price though. You can see it's inside the candle. It needs to get above. If you want to look, if you're looking for all of the elements to be, you know, on par. Let's keep going. We got REGN. And so Regeneron Farm, as you can see, has been moving up these multiple weeks here. But the problem is where it's stalling. The Kijinsen, the red line. 200-day is lurking above, so is the cloud. I'd stay out of that one for now. If you look at the daily chart, it has burst through the cloud, and the next level of resistance on the daily chart will be the 200-day moving average, which is about 6% away. Okay. So yeah, on the shorter time frame, it's looking pretty good. If you're looking to day trade this, you certainly could. You could use the daily time frame, and you could use a 2-hour. You can see on the 2-hour how it's in an uptrend. You could use a 5-minute. All right, you can see back here in the morning it moved up, but then it started to drop throughout the day. Right, so from the high up here at around 12 p.m. today, Thursday, it dropped about 1.18%. How about NOW now? Service now. Let's look at the daily chart. That was Malcolm's final trade. So here's another one I would not recommend here based on the technicals. As you can see, price is under the cloud. It's under the 200. It's under the 26 period. And if you look at the weekly chart, okay, it's under the Ichimoku cloud here too. So no on now. What about BMY, Bristol Myers? Here it is in the weekly. It's under the cloud. That was Jenny's final trade today. Jenny Harrington. On the daily chart, it is above the cloud. It's starting to show a little bit of strength here, but we still haven't broke above that high right there. You can see that it's been testing that area here, getting stuck. So maybe that will pop up on Friday. But again, if you don't have both time frames, the weekly and the daily confirming, I certainly wouldn't consider taking a long position there. You're taking a chance. It's a higher probability positive trade if both time frames align, okay, and you've got synergy in both. Tesla on the weekly chart, inside the cloud, no on that one. And what about on the daily? It's under the Kijinsen, so no on that one. Apple, here it is on the daily, under the Tenkan-sen right now. It's been dropping now multiple days since August 14th. Here it is on the weekly chart, inside the cloud. As I mentioned, it's not a good idea. Even though it broke through that trend line, it looks like it's, you know, now just kind of stalling, because the cloud itself is a very strong level of resistance, the top of the cloud. All right, and you can see it's reversing right now. We had a spinning top last week, okay, which is a reversal candle. As I've mentioned before, those are, if they happen at the top of a move, they can be bearish. It's when the wick on the top of the candle is equal to the wick on the bottom, and you have a small body in the center, and it looks like a spinning top. All right, so that's what's happening there. What about Meta? Meta on the weekly chart is, did it close under the Tenkan-sen? Let's see. It's at 739.10 is where it closed. And on the, let's see, 737.50, it is above, it's still above the 9 period, okay? If we look at this on the daily chart, it's under the Kijinsen, so it's not a buy signal quite yet here. You can see it broke under that prior high of 747.90, so I would hold off on Meta. It's been dropping. Let's see. Let's get into some of the sectors now. All right. I reviewed all 23 of these sectors and ETFs that you see here. The strongest ones are the ones with the blue flag. Why? Because they have strong technicals still on the weekly and the daily. So here's IJJ, the mid cap, okay, 400 value ETF. Here it is in the daily. You can see it's still holding up above, but stalling at that 129.17, right? We need to get above that. Here it is in the weekly chart, barely above the cloud, barely. The cloud itself has turned bullish here, you can see. What about XLF financials? That one too on the weekly chart, still holding up above the moving averages and on the daily. Okay. But not looking ultra bullish here. Again, just a very long and extended consolidation going on here. Look at that box. Price has been contained, right? And so what we're looking for is a catalyst, something that's going to lead to the price breaking through these levels. And it could be tomorrow. It could be next week, right? We don't know. So we'll find out soon enough. GDXJ, on the other hand, all right, so at a time of uncertainty, what does well? Gold. And so the gold miners ETF is doing well. You can see it broke through that high right there. Okay. And I added a gold position, gold stock, in the members only video today. If you want to find out what stock that was, you can become a member. There'll be some information at the end of this video on how you can become a member to access the members only video plus the daily posts for Blue Cloud Legend level members, where I go over basically I add new positions, I close out of positions each day, and I share those with members. COPX, Global X Copper Miners ETF. This one here popped above the Tenkan-sen after 2 days of being under it, so it gave us a new little buy signal right there. On the weekly chart, on the weekly chart, it still looks pretty bullish as well. GDX, which is not the gold mine. This was the junior gold miners. This is the just gold miners ETF, and you can see that once it broke through that box, which happened on Friday of last week, you can see 3 weeks in a row it's been moving up. Here it is on the daily chart. So on the daily chart, it looks really bullish too today because it broke through this right there. You can see that right there. It broke through that little trend line there. The directional movement index is looking strong because positive DI is moving up. The negative DI is moving down. ADX looks like it's starting to move up a little bit. XHB is the home builders ETF. And this one here, as you can see, basically still holding above the Tenkan-sen, barely. Okay. But it's still in the consolidation mode. And on the weekly chart, okay, it actually has entered the cloud, but last week it did close above. Now here's the thing, I left this, in here. I still left a little blue flag only because this candle here is dynamic, right? So this candle has not fully formed quite yet. All it needs is to move up slightly, and then it will be above the Ichimoku cloud. So if we have a bullish day tomorrow, that could be good. The ADX is moving up on the weekly, and the green line is above the red line, so that's bullish. And like I said, on the daily chart, we're losing a little bit of steam here, but it all depends on what happens. I think, tomorrow's going to be a big day. I'll just kind of scroll through these really quickly, only on the daily chart, and just kind of give you my assessment here. ETH is under the Tenkan-sen. Ethereum's pulled back, but holding up above the Kijun-sen. Silver is above both moving averages, but the Tenkan-sen is under Kijun-sen. Oil K, which is the ProShares K1 free, where you don't have to file a K1 form with your taxes if you're getting this particular ETF. That one's stalling under the cloud. No on that one. XLC is under the Tenkan-sen. IBIT is under the moving average there. SMH, semiconductors, also same thing, but holding up above that 283.07. Gold is inside the cloud. Real estate, XLRE is under the 200-day and under the Kijun-sen on the daily. XLY is under the 9 period. Utilities is under the 9 period right now. XLV, healthcare ETF, is above the cloud, but stalling around the 200-day. XLP, consumer staples, is under the Tenkan-sen. XLK is under the moving averages. So is industrials. And energy, XLE, is inside the cloud and under the moving averages there. The granny shots, Tom Lee's, is stuck still in that box, as you can see right there. XLB, that's the materials ETF above the cloud. Okay, and that's it. We got back to the original IJJ, which we covered. That's going to do it, guys. So, a couple of things. If you like the software here, let me show you guys how you can get access to this software. Okay, so first what you want to do is just come to my YouTube homepage here, Blue Cloud Trading. At the very, very top, next to this link here, you'll see this right here. It says 9 more links. Click on that. And if you scroll down a little bit, you will find the coupon link right there, tc2000.com/download/Blue Cloud Trading. There's the link. You can enter your email, download the TC2000 for Windows, and then basically you will receive a $25 coupon towards your TC2000 service courtesy of Blue Cloud Trading, as long as you haven't used the service in the last 12 months. TC2000 has recently also partnered with NASDAQ. And so what's happened is they actually provide real time, okay, As you can see here, real-time U.S. stocks on the NYSE, Amex, and NASDAQ provided by NASDAQ Basic. So if you become a member, or basically you take advantage of the service, let me just switch it over to monthly so you can see the correct pricing for monthly. This is biannual. You only pay $18.74 if you pay once every 2 years. If you pay it monthly, it's $24.99 a month for the basic. And so right now under this basic, you get stock option charting. As you can see, these are some more things that they've added: live streaming watch lists, customized layouts, real-time financial news, and practice. You can practice paper trading, which is pretty cool. You know, if you're a newbie. If you want more stuff, like you go to the next service, premium, okay, and under here you can see that what you get. You can also use the chart drawing tools. I think that's important. You can do the easy scan. You can basically track over 100 track up to 100 alerts right there. And if you become a premium member, you get these additional things: the real-time market pulse gauges, real-time market pulse indicators, intraday performance columns, and track up to 1,000 alerts. So, all right, and so yeah, you should consider this. Now, one other thing I just want to mention is in a few seconds I'm going to post a pre-recorded video on how you can actually also become a member, all right, by clicking that link there. So stay tuned for that. If you want to stick around to find out a little bit more about the members only video that I post each weekend, all right, let's talk about that for a moment. So you're coming to this channel for the first time, you may not have subscribed yet, which is kind of crazy. Can't believe that you haven't subscribed. You know, this is free. Hit the subscribe button. I'll be popping up in your subscriptions in the future. If you hit the notification bell as well, you will be notified. So where's the notification bell? Well, once you hit the subscribe button, okay, it will pop up the notification bell, and then you can select that. Another interesting that you'll notice is that you get this little plus button right next to the subscribe. That happens after you've subscribed. Why? Because they're giving you an option now to join, all right? And if you click on subscribe at plus, once again, another thing pops up, and this is the membership. This is where you can support the channel, okay? You can either become a Blue Cloud supporter, a Blue Cloud trader, where you get access to exclusive member-only videos here under Blue Cloud Trader. Under Blue Cloud Legend level membership, you get those member videos. You can get access to day trading videos, as well as the daily trade updates that I post. Now it says here under the community tab, it's not actually under the community tab. It will pop up in this next thing here. Boom. Once you've become a member, you'll see a new tab pop up called membership. You click on that, and that's where you'll find those daily posts on the trades that I've placed. What do I cover in this members only video? Like this one here, for example, that I posted just 21 hours ago on August 8th. I go over the, whoops, hold on one second, let me go back. You will see exclusive member only video. Okay, weekend update on the trades I placed throughout the week, plus new stock ideas for the upcoming week that are setting up. Okay, and all you need to do is just scroll down. You can see you'll have access to older ones as well. All right, so you get a more insight about my trading strategies and you know, the stocks that I'm actually holding, plus those 20 new stock ideas. All right, something to consider.